And thanks for joining us for the webcast, How to Respond When Your Organization Receives a Letter 226J from the IRS, sponsored by First Capital Consulting. Before we begin, I would like to remind you that this webcast has been pre-approved for HRCI credit and may also be used for SHRM credit as well as World at Work certification. Make sure you attend the complete webcast today in order to receive your credits. You will receive an email from hr.com within 2 business days, which will include the certification credit information. You may also log into hr.com and go to your View My Credits page where you can find all the credits you have received with us. If you have any questions today, please type them in the Questions tab on your GoToWebinar control panel, and we will follow up with you. Our presenters today are Joanna Kim Brunetti and John Leathers.
Our speakers today, as Sherry mentioned, are Joanna Kim Brunetti and John Leathers. Joanna is our Vice President of Regulatory Affairs, and John is our Director of Product Implementation. Joanna, do you want to just talk a little bit about what you do in the role of VP of Regulatory Affairs?
Sure. My role is to provide regulatory oversight for our company's ACA team, providing them technical guidance, and with respect to our software development team, keeping our ACA team up to date on IRS regulations and rules and guidance.
Perfect. And John, what does a Director of Product Implementation do?
Sure. I'm heavily involved in the design, the development, and the delivery of our portfolio of products and services, and in particular, the Affordable Care Act compliance consulting business line. So had the opportunity to watch that arc develop over the last 5 years in terms of companies' awareness around the ACA, and so we're excited to be able to share knowledge that we've gathered from our customers and end users today.
Super. So the first thing we're going to do is let's start off with a poll question. So Sherry's going to throw that out there.
So I have that poll on the screen now, Gary.
Okay. Am I doing it correctly, Sherry? If not,
You sure are. No,
okay.
No, I'll close the poll now. And if you're not able to see, I'll share the results. We have,
yeah, please do.
Yeah, we have 44% saying yes, 8% no, 25% probably not, and 22% not sure.
Interesting. So almost half of you were expecting the IRS would send ACA employer mandate penalty notices at some point. So that's interesting to us. So Joanna, do you want to talk a little bit about what starts all this process, which is really the ACA employer mandate? Do you want to discuss what that is?
Sure, and I do find it's interesting that in the polling, less than half of the people were certain that the mandate was in effect, which means that more than half weren't sure or didn't think it was in effect. And let me tell you, the employer mandate is a legal obligation on the employers to offer health coverage to their full-time employees. And that has actually been in effect starting January 1, 2015. And it is in full force today. This employer mandate applies to organizations with 50 or more full-time or full-time equivalent employees. And these full-time equivalents are basically kind of cobbling together part-time people to come up with what's called a full-time equivalent. And these employers that have this 50 or more full-time or full-time equivalents are referred to as applicable large employers. And as these applicable large employers, or us in the industry call ALEs, these ALEs are required to make these annual information filings with the IRS, and these are basically what's called information returns. And in these information returns, the ALEs need to identify the offers of coverage that's provided to their full-time employees and their dependents, and whether or not they complied with those that obligation to offer. And if the ALE did not make the appropriate offers of health coverage, the ALE can be assessed by the IRS what's called an Employer Shared Responsibility Payment, or ESRP. And these things are really the focus of our discussion. So if an ALE does not make offers of coverage as required under the employer mandate, the ALE can be assessed these employer shared responsibility payments.
So, Joanna, what do you do if you get a letter 226J?
Well, as our PowerPoint, in somewhat humorous fashion, hopefully, the first two are bad solutions. Throw it out as junk mail. It is not junk mail. You do not want to ignore it. If you are an employer and you receive one of these, typically these letters say you have 30 days to respond. So what are you going to do? Are you going to do it yourself? Or are you going to call someone who knows how to do 226Js? And in our presentation today, we hope to provide some, understanding of what these 226Js are about and how to respond to them.
So, Joanna, how does the IRS determine who's going to get a letter 226J?
Well, basically, the IRS will access its databases as well as reports that it receives from what's called exchanges. These exchanges are basically the government entities that issue out the premium tax credits to individuals who are seeking health care coverage through the exchange. If they do that and then they're eligible according to the information they submit to the exchange, they will receive what's called a premium tax credit. If they receive one of these, the exchange sort of collects these sort of reports of who received these premium tax credits, or PTCs, and then they send that list to the IRS. So the IRS takes that list of who got a PTC, they compare it with the information returns that are filed by the employers as well as other databases to determine which employers to send out these 226J letters.
So, Joanna, with that, here's what a sample first page looks like from the letter 226J. Do you want to explain what we're looking at here?
Sure. This is the first page of a 226J letter, and this is a real letter that was in fact received from the IRS. What we've done is blacked out everything that's confidential about it to kind of give you a sense of what they look like. And the most important part in that center box, you'll see it says proposed ESRP. For this particular client, it was $6 million. And so that amount, that ESRP, that can be really scary. We've seen ones as high as $20+ million. Of course, that depends on the employer and their workforce count, but these numbers are huge. And this is the amount that the IRS is proposing that your client pay, or you as the employer pay, to resolve the ACA penalties for, in this case, this is a 226J on the 2015 year. So this is what the IRS is proposing that the employer pay to comply with their ACA obligation.
And as you notice here, the ESRP is not tax deductible.
That's right. That's right.
So how does the IRS go about calculating that ESRP?
Well, if you go to slide 9, you'll see this is another page in that sample letter 226J, and what it is a summary table of how they came up with that number. And you'll see the different columns. On the first column, you see the different months, and you'll see it from January through December. And then in the next column, you'll see whether it's either going to be a yes or no box. And in that box, that identifies whether the employer offered at least 70% for the 2015 year of all full-time employees and their dependents, whether coverage was offered. Now, this is, as I mentioned earlier, the IRS is collecting the PTC data from the exchange and reconciling it with the information returns that the employer filed, along with other databases. So they know what the employer is asserting, yes or no. And so if the answer is no, that means that you may be potentially subject to penalty. And in this particular example, you'll see that it's no in every box. That means each one of those months, you're potentially subject to what's called an A penalty, which I'll talk about later. And then the next column, you'll see, in the next column, if you could go back to slide 9, in the next column, column B, that's the row for the full-time employee count. And obviously, the bigger number you see there, the higher the penalty is going to be for A penalty. The next column, C, is what we like to call the freebies. And for 2015, if you check the right box on your 1094C form, you would get 80 instead of 30. And that's a big difference because that number is reducing the full-time count. So you take the B column minus the C column, and then you get the number of employees that they are going to base the penalties on. And then what they do is they multiply it. For the A penalty, you look at the full-time assessable count in column D, you multiply it by 173 bucks a month, and that's how you get the ESRP for the month. And then at the bottom, you'll see the total for all 12 months.
So just to summarize it, Joanna, what are the key essentials that people should focus on when they're looking at that table?
Well, as I mentioned, that column B, where, did you check the yes or no box in terms of offering the required threshold for coverage? The next column, which is the full-time count. The column after that, the number of freebies. And then for that last column, that fourth column, which I hadn't talked about earlier, that's the number of employees who are listed as obtaining a PTC. And that's going to be significant because for A penalties, and again, I'll talk about that in a minute, for A penalties, if you have just one person who is eligible for a PTC and got it, that triggers the A penalty. The B penalty, which I'll describe in more detail later, is only triggered with respect to those employees who got a PTC. So that column is also important to look at, and of course, looking at what the ESRP is for each month and the total.
So let's talk about those A and B penalties, Joanna.
Okay, so the A penalty is triggered, and at least for the 2015 year, if the ALE failed to offer what's called minimum essential coverage to at least 70% of its full-time employees and their dependents, and at least one of those full-time employees obtained a PTC. So if you're an employer and you've got 100 full-time employees and just one of them got a PTC and you failed to hit that threshold, which for 2015 is 70%, you're going to get tagged for all 100 employees, even though only one employee got a PTC. Contrast that to the B penalty. The B penalty is triggered for each full-time employee who obtains a PTC. So it's a per PTC employee. And so that dollar amount is higher on a monthly basis, but again, it's only triggered with respect to those employees who obtain a PTC. And not, what we've seen in the last 3 years of compliance, not every employee who could have gotten one gets one. So, and then the last point is the A penalty is the cap on the B penalty. So for any given month, you can't get penalized for more than what the total would be for the A penalty.
Great. Now, John, one of the things that's also in the letter 226J is the PTC listing from employees, those employees receiving a premium tax credit. Do you want to talk a bit about that?
Sure. So just to remind everyone, these people that receive premium tax credits were active employees and went on a health insurance exchange and obtained a premium tax credit. And that's the reason why this 226J letter was issued. The IRS has certified that for at least 1 month during which the employees that are listed on the 226J letter were full-time employees, they received a premium tax credit, which is what's triggering the shared responsibility payment. And there's really two simple high-level reasons why these folks are triggering penalties. One is that what was reported to the IRS indicated that such employees were not offered health coverage for months during which they were full-time, or number two, they weren't offered health coverage for a month for which they were full-time, but that coverage that was offered did not meet the minimum value threshold, which deals with cost sharing, or it was not communicated to the IRS as having been an affordable offer of health coverage. And so those premium tax credit employees are all listed on Form 14765, which I believe we will review here next.
Yep, right here. There you go.
Perfect. So this is an example of a comprehensive listing of the premium tax credit listed employees that are actually triggering the potential employer shared responsibility payment. So the IRS obviously communicates the identity of the individual in the form of the name and the last four of the social security number. And then they break out by month, January through December, the specific months for which an employee is triggering or not triggering an employer shared responsibility payment. And so what the IRS does is, for months which they highlight, the employee is not triggering a potential payment, and for months which are not highlighted, those are the months that an employer needs to drill down on and examine closely to identify whether what was communicated to the IRS is in fact accurate. And so you'll note that they actually communicate to the employer in the letter and on this form the code combination that was reported on Form 1095C. And so they will list line 14, which deals with the offers of health coverage, and line 16, which deals with any potential safe harbor codes. And that allows the employer the opportunity to examine whether they agree with the assessment. And this form, actually, this listing, to the extent that the employer wishes to change the codes when they respond to the 226J letter, it will actually make changes directly on this form beneath the coding combinations that have been communicated by the IRS.
So of the critical things that are listed there, John, it sounds like the codes play a critical role in how the PTC determines whether somebody may have required a letter 226J.
You hit it on the head there, Gary. It all deals with the codes. The codes are what are determining whether the IRS believes there should be a responsibility payment for that particular month. And so we'll look at the specific codes here in a moment, but in a nutshell, it all comes down to what did you communicate to the IRS was the health coverage that was offered for these specific employees, and was there any safe harbors that applied? And so what we see just in the work that we've done is, frequently the codes were determined incorrectly, and many times that's the function of the underlying data that was uploaded to whatever the platform that was used to create these codes being incorrect. So it's important to be able to go back and examine what in fact was the underlying data, so that you can determine whether the codes that were communicated are accurate. And many times that's difficult just because it's been a few years now and the documentation and record keeping perhaps isn't what it could have been.
And I see when you make corrections, you can do it right on the listing in the ESRP calculation.
That's correct. Yeah. So if you're going to make coding changes, you would do so on the list that we just looked at that communicates the employees and the specific line 14 and line 16 codes. And so I think that we can look at those some of those codes just so people kind of understand what it is that that the IRS is expecting.
Now, John, let's talk about some of the more interesting combinations of codes that can cause a problem.
Sure. So we're looking at the 1 series codes here. So these are the codes that are going to be communicated to the IRS on line 14 of the 1095C schedule. And so again, this deals with telling the IRS what kind of health coverage was offered for specific months. And so I'm not going to go through the codes in detail, but what I will say is that in the work that we've had the opportunity to perform, assisting employers in responding to these letters, it's very obvious that the codes were misapplied, and that's a function of really 2 things. One is that the logic was misunderstood, and so the incorrect code combination was selected, and or the underlying data, again, was inaccurate, leading to incorrect application of the codes. And so if, for example, an employee received a premium tax credit for a particular month, and they were coded as 1H on line 14, indicating that they were not offered health coverage, and they were a full-time employee for that month, that would communicate to the IRS that there should be an employer shared responsibility payment assessed on the employer for that month, because the employer failed to meet their obligation to offer that full-time employee health coverage.
John, any other examples of 1 series codes where?
So we see common confusion between codes 1A and codes 1E. Separately, we've seen code 1F used when it should not have been used. So code 1F communicates to the IRS that the health coverage that was offered did not meet minimum value. And when, the actual health plans that were offered or examined, it turns out that they did meet minimum value. So there's just a lot of confusion, particularly back in 2015. It was very new to everyone. And so it's important to be able to drill down and determine whether what was communicated to the IRS was in fact accurate.
So John, what about the 2 series codes? Any interesting combinations there that are tripping people up?
Yeah, so the 2 series codes, again, so these are communicated to the IRS on line 16 of the 1095-C form. And what the 2 series codes are designed to do is communicate to the IRS, look, for reason A, B, or C, we should not be liable for a shared responsibility payment. And that may be, for example, that the individual listed on the form was not an employee for a particular month, or they were not a full-time employee, or they were offered health coverage that met an affordability safe harbor. So one common issue that we've seen manifest is that the affordability safe harbors were not correctly communicated. Either they were not communicated at all, or the incorrect affordability safe harbor code was applied. And very often, a lot of the situations that we see that are defensible are simply that there should have been a 2 series code indicated and it was not. And that by fixing that, by examining the data and the fact patterns that transpired during 2015 and communicating the required changes around these 2 series codes, the IRS, you can reduce the employer shared responsibility assessment.
So Joanna, we've gone through now all the different things that might need to be corrected. What's the next step in responding to the letter 226J?
Well, part of the 226J gives you what's called Form 14764, and that is the ESRP response. And it's a form that the employer would submit to the IRS to respond to the 226J, along with that Form 14765, which is the PTC listings with whatever coding corrections that are applicable. And in the ESRP response, you essentially have 3 options. One, you agree and you enclose payment of the proposed ESRP. So, we talked earlier about the scary amount. If you want to agree to it, it's pretty much done. You can agree, enclose payment, and then you're done. Now, if you disagree, whether partially or totally, you must submit an employer statement identifying the disagreement and whatever support you have for it. Now, also, you could do nothing. If you do nothing, the IRS will send a follow-up notice, which is a notice in demand for payment, and that notice in demand for payment can go through the collections process, and the IRS will collect. Now, when the employer receives a 226J letter, the employer can seek an extension to respond if they need additional time. And certainly, in the significant experience that we've had in responding to these 226J letters, the IRS has been very reasonable about extensions. You clearly want to do that before the deadline, number one. And number two, whatever extension you're seeking, is be reasonable about it. The phrase goes, pigs get fat and hogs get slaughtered. You ask for too much, the IRS isn't going to be as receptive. So figure out how much time you need and, explain to the IRS why you need the additional time, and they're very reasonable about it.
So Joanna, here's a sample of how that response can look.
Yes. So as I mentioned earlier, you're going to fill out the form. A lot of it is pretty simple information. The big ticket item is under that section where it says indicate your payment options, and right above that, partial/total disagreement with proposed assessment. So if you're going to disagree, you check the box, I disagree with part or all of the proposed assessment, that's going to trigger your obligation to prepare a client statement. And that statement is something you're signing to the IRS representing that, whatever the employer is disagreeing with and why and what's the justification for it. And we'll get into that in a bit.
So, Joanna, we're going to jump right in now with a second poll question that's going to foreshadow some things we're going to talk about ahead. How do you measure FT status? So, Sherry, you have that up there? Great.
I sure do.
So, Sherry, how do the results look?
I'm just going to share them on the screen. So monthly measurement method, 10%. Look back measurement method, 67%. Employee census listing, 13%. And not sure is 10%.
Great.
Wow.
Interesting. Joanna, what's your reaction?
Well, I'm sure that the folks that have been looking at the different methods will see that the monthly measurement is the easier and sanctioned IRS method that an employer can use. The look back and all the ones that we've seen other companies do on behalf of clients or the clients have done for themselves, there's always been errors. Look back is a tricky one. And I thought what was really interesting is 67% of the folks that have that have taken the poll have been using the look back measurement. And we can get into that in a bit about the look back measurement, but it is very tricky and there's a lot of nuanced rules that go with it. Now, with regard to the 13% that used employee census listing, I want to make clear that the employee census listing is not a sanctioned method by the IRS. The IRS does not permit you to do that. Now, it could be that your employee census listing happens to match the monthly measurement, and then, you by result would be accurate. But if your employee census listing does not match the monthly measurement method, that could be potentially a problem. Now, if you aren't sure how you measure the FT status of your employees and you're an ALE, you need to get sure because that needs to be done. And we'll talk a little bit more later about sort of the impact of not doing this. Although I think it's pretty evident at this juncture, it's really important that you measure your full-time employees if you are an ALE.
So, Joanna, let's jump back into the letter 226J. And if you disagree, what are some of the things that you can do?
Okay. So, certainly in terms of the common grounds that we've seen, one of them is on the first page of the 1094C, where it's a section called Certifications of Eligibility. And there are a number of boxes that you can check. Now, the ones I want to focus on are the key ones on dealing with Section 4980H transition relief. It only applies to 2015, and this transition relief is extremely valuable for those who are eligible. So the first one is what's called the 50 to 99 FTFTE eligibility. If you are an ALE that's over 50 but under 100, you could basically bypass any penalties, A or B, for the 2015 year. You'd have to be eligible. And basically the eligibility consists of having a workforce in that range, and the employer didn't reduce the workforce to sort of shoehorn themselves into that range. And whatever health coverage they had been offering their employees, they didn't reduce that for that 2015 year. And certainly in our experience, we've seen most employers who fit in that 50 to 99 range. It's fairly easy to show that you're eligible. If you're able to check that box, what's very valuable is you're not subject to any A or B penalties. So that's a great one if you can fit yourself in there. Now, the second one is if you are 100 or more full-time / full-time equivalent employees. Now, I had earlier mentioned about the 80 freebies. This is a big deal because, so if you have, let's say, you have 100 full-time employees. If you have 100 full-time employees, and let's say you didn't offer the requisite 70% for 2015, to your full-time workforce. If that's the case, and you check this box, you would be able to subtract 80 from that count instead of 30, which is the sort of default number. So this is a box that there's no reason why you shouldn't be able to check it, but we have seen time and time again employers who had failed to check the box. So as part of your disagreement, you could say you were entitled to check that box, and you are seeking to check the box, and so you should get 80 freebies instead of 30. So let's say you had 60 full-time count that month. You could, if you subtract 80, that means you're not liable for any A penalties. But if you failed to check the box, you'd only get 30, and so 60 minus 30, you would still be liable for 30 full-time employees. So that's also another big deal.
Joanna, you want to talk a bit about qualifying offer method transition relief?
Yeah, that one, that one we have seen, it hasn't been as useful as the 4980H transition relief. But so, for example, if you had made an offer to all of your full-time employees for all 12 months, you can check that box, and it reduces some of your reporting obligations, which is very handy. But in terms of reducing your penalty, 4980H is really where we've seen the biggest bang for your buck.
And I would say probably the same thing about the 98% offer method.
Yes. Look, those are the other sections in the certifications of eligibility. One of the things that you're going to want to do with those certifications of eligibility, and the PTC listings that John had mentioned earlier, and getting the codes right, obviously that coding needs to reconcile with the qualifying offer method and the qualifying offer method transition relief. Now, some additional bases, and that goes into slide 21, other grounds is, you should have said yes instead of no. You failed to check the right box. You checked the no box when you should have checked the yes box for having offered this minimum essential coverage, which is essentially an employer-sponsored plan to 70% of your full-time workforce and their dependents. If you did that and you checked yes, you will bypass the A penalty for whatever month you check yes for. So that's a huge change, where if you didn't check it and you checked it, that's going to make a huge impact on what A penalty that the IRS is proposing on you. And again, I had mentioned earlier about the section 4980H. That's another one that's a huge reduction of the A penalty if you're able to check the box, which, as I said, is very easy to do.
Now, John, what happens if you get your full-time employee count wrong? What are some of the issues there?
Well, there can be, pretty dramatic effects, negative implications that can arise from improperly determining the full-time count, and we've in fact seen that happen. Because remember, the A penalty is based on the full-time count. So to the extent that the 70% for 2015, the 70% offer health coverage threshold was not met for a particular month, the IRS is going to take that full-time count and they're going to reduce it by the allowable number of freebies that Joanna talked about, and then they're going to determine the penalty amount. And so what is common is that employers have incorrectly listed their full-time counts. Sometimes that's because they incorrectly applied one of the allowable measurement methods, either the monthly measurement method or the look-back measurement method. Sometimes we've seen situations where it's clear that there was no measurement applied at all, and what was actually reported was simply the active employee count. And so, again, reporting the full-time count as the active count is going to be not good, because you're overstating your full-time account. That's increasing the number of accessible employees that the IRS can base that potential A penalty off. Joanna,
so how do you go about correcting? How do you go about correcting that issue?
Well, you have to go back and you have to take a look at the data. And so, if for those that are familiar with the look-back measurement method, the look-back measurement method involves looking back at a period of time prior to the applicable reporting year. So if you're looking at the 2015 tax year, you're probably going to obtain data back into 2013. So you need to go back, get that historical data, and determine whether that measurement methodology was correctly applied. To the extent that it wasn't, you're going to want to make sure to correctly apply it, to document that, because after all, this is going to serve as the basis for something that's communicated to the IRS. So you want to be very sure that what you're communicating, to the extent that you're changing any of these counts, is able to be substantiated in the event that they want to see the supporting documentation. And so it involves going back, looking at the data. There are nuances to consider. If one method was used, it may not be appropriate to use a different method. I won't go into that level of detail right now. And then in terms of, go ahead, Gary.
No, just the coding errors too. We covered that as another big problem that needs to be addressed.
And I want to just add to that with regard to coding errors. There are some coding combinations where it's not necessarily an error, but there's other coding combinations that are also applicable, but far more favorable from a reducing or eliminating the penalty. Right, John?
Correct. Yes, correct. So all of this needs to be considered. And again, we see a lot of errors that are clearly due to one of two things. The logic was incorrectly applied, or, and this is very frequent, the underlying data that was actually uploaded to the system, portal, or platform determining the codes was inaccurate, and there was no data validity or integrity checks performed on that data. And so what ends up happening is the codes are sometimes accurately reflecting the underlying data, just that the underlying data is incorrect. So you need to go back.
And how can this help?
All of that.
How can this help eliminate or reduce the B penalty?
Well, so remember that for any particular month, you're only going to be assessed one or the other in terms of the A penalty or the B penalty. So if you document and you feel comfortable indicating to the IRS that you met the 70% offer health coverage threshold for 2015, that will allow you to be safe from the A penalty, to the extent that you can correct the code combinations at the employee level, you're going to be able to reduce the B penalty. Every time that you can communicate to the IRS for a particular month, look, this employee should not be liable for triggering an employer shared responsibility payment, that's going to be a good thing. And that refers back to those 1 series and 2 series codes that we looked at. Examples of positive changes that you might be able to communicate are the employee was originally perhaps communicated to the IRS as being a full-time employee, when in fact they're a part-time employee upon closer, more accurate analysis. And so you would be able to communicate that to the IRS. Look, this employee was not a full-time employee for this particular month, so therefore we should not be liable for an employer shared responsibility payment. Or another scenario may be this employee was originally coded as not having been offered health coverage, but in fact they were offered health coverage, and that coverage met the minimum value threshold and was affordable. And so that's the reason why we shouldn't be liable for a B penalty for that particular month for that employee.
So Joanna, in terms of the ESRP response, you also have to include an employer statement. Do you want to talk a bit about that?
Sure. And, as I said earlier, if you are going to disagree with the proposed ESRP, either partially or totally, you need to submit this employer statement. It does need to be signed. And what goes in there is basically you're explaining what you disagree with, why you disagree with it, and what support you have in terms of your disagreement. So, obviously we've talked about a bunch of different sort of corrections you could make with respect to how the IRS had come up with the A penalty or B penalty. But, this is your opportunity to describe, for example, if you in fact offered minimum essential coverage to that 70% threshold. You want to state it, you want to explain what your, you as an employer, how you know that you hit 70%. And I want to mention that, we've spoken with IRS agents, and some of them have indicated you don't need the documentation, just explain. And I'll tell you, the more sort of solid your explanation is, the less interested. Why would the IRS be interested in looking through, volumes and volumes of supporting documentation if you've explained very clearly and credibly why that needs to change from we didn't offer 70% to we did offer it? Provide an explanation. And if you're not going to include the documentation, identify what the documentation is, and what you're doing is you're signaling to the IRS, hey, if you ask us for copies of these things, we've got them. These are the details of what's in there. And then, when you're talking about the full-time count, explain how you came up with the full-time count, where that's the pertinent issue that you're sort of disagreeing with. And, the 2015 is a good faith year. That's a good faith transition. So, really explaining your basis is key to succeeding in the 226J statement.
And you have an interesting note at the end of the slide here.
Oh, the statement must be signed?
Yes.
Yes, it must be signed. You're saying this is true, and so you want to make sure that whatever you're stating to the IRS is accurate. Let me talk a little bit about, and this is on slide 24, in terms of documentation. John had mentioned earlier about minimum value, how that's one of the things that you need to show, in particular to get rid of the beat penalty for a particular individual. That's super easy to show. Health plans will have what's called a summary of benefits and coverage, what we call SBCs. And almost always, for whatever reason, it's on page 6. But it identifies, the insurer, if you have a fully insured plan, the plan specifically says whether or not minimum essential coverage and minimum value are met. So you can refer to that in your employer statement. You could attach it. Another way to show, like the premium rates, you're saying, well, let's say you made coding corrections on the affordability. Your original submission to the IRS suggested that it wasn't affordable, and that has a very sort of specific definition that the IRS identifies, which we could have a separate webinar just on that. But it's essentially 9.5% of the employee's wages, and that's their various safe harbors. But with respect to that affordability, one of the ways to sort of show why it's affordable is, you might have rate sheets that were circulated to employees saying this is the, for example, a uniform rate for all the employees, or it's for that particular person. But that sort of documents that was the offer and how much that employee was going to have to pay per month to get that coverage. And so that's going to be highly relevant to show that something was affordable. Now, in terms of the offer of coverage, and this goes back to, did you hit that 70%? You'll see on the next slide an example, which is an acknowledgement of an offer of coverage. And that, I've seen, various different forms, and this is just one sample, and this is a sample of a very thorough acknowledgement. And this one shows the employee signs off on that he or she got an offer of coverage, identifies the plan that was offered, when the offer was made, the time frame for the coverage, what that offer entails, and the fact that that person had declined. So this also happens to be good for exchange appeals, but that's outside the scope. But anyway, having this makes it very clear that the employee got an offer of coverage. Now, I hadn't emphasized this before, but I want to make clear that the employer mandate requires the employer to offer it. The employer mandate does not require the employee to enroll in it. And so that's a big difference. And that is why these sample acknowledgments of offer is key, because obviously, if an employee enrolled in it, it's sort of assumed that the person was in fact offered. So it's easy to show, well, the person was enrolled, hence they were offered. But if they declined, what's your documentation for that? And showing the 70%, that may be very important to it.
So, Joanna, once we have the response completed and submitted, what's the next step?
Okay, so if you as the employer submit your response, the IRS will send its sort of counter response to that, and it's called a letter 227. And according to the IRS, there's 5 versions. We've seen some of those 5 versions. A very good letter 227, which is called a letter 22K. It pretty much says, we've received your response, we agree with you, you don't owe anything, bye-bye. That is fantastic. That is the 227K letter. Another letter we've seen is a letter 227L, which is also a very good letter. The IRS is still agreeing with the employer, but when the employer submitted the response to the 226J letter, what the employer was saying is, hey, I partially disagree with you. The proposed ESRP for $1 million, it really should be $1,200. So the IRS could respond to that with a 227L saying, yeah, I agree with you, please pay the $1,200 essentially. And, we're very fortunate, and, based on our expertise, we have received letter from our clients, letter 227K and 227L, based on our assistance in handling that employer's 227J, a letter that they got from the IRS as a result of them submitting erroneous information, before they became our client.
Now, there are 3 other versions which are not as great to receive, right?
Right. So the other 227 ones, we have also seen a letter 227M, and I want to make clear that's not based on something we did. It was from a different vendor. But the letter 227M is basically saying, I got your 226J response, and I don't agree. I'm going back to my original 226J, proposed assessment. And so that's basically just rejecting what the employer is saying. So if you get a 227 letter in there, it'll tell you what the next steps are. And the next steps are, in essence, an employer can request a pre-assessment conference with the IRS. It gets more complicated. And just sort of logic will tell you that the further along you go in this process of protesting, the harder it's going to be for the employer. What you really want to do is knock it out of the park, the 226J response. Now, presumably there's 2 other versions, and we haven't seen them yet. Now, mind you, the 226J letters just started coming out in November. That was only a few months ago for 2015, nearly 3 years later. Now, the IRS has indicated they are going to continue sending out 2015. It's just a deliberate, process where it's just taking time, but they're getting to it. They will get to it. So it's, hopefully you'll get a 227K or a 227L. The 227M and onward, those are going to be more challenging to respond to. So
what about the idea of requesting a pre-assessment conference?
Yes, you can do that, and then that process would involve engaging in a discussion with the IRS agent to sort of state your case. But if you couldn't prove your case at the 226J response level, what new information are you going to have? Perhaps you didn't do a good job on the 226J response, and this is your opportunity to clean that up. They said it just seems more difficult to succeed the further along you get in the process. So that's just something to know. And we've provided in slide 28 an example of that 227K letter, which is a good one.
We like no further action is required at this time.
Right. and
so now,
what happens if you don't respond? You've got this is what's going to happen. If you don't respond, as I mentioned right out of the gate, the IRS is going to issue a notice and demand for payment of the proposed ESRP. And that proposed ESRP will go to the IRS collections process. Not good. that ESRP is subject to an IRS lien and levy enforcement actions. Interest will accrue from the notice and demand until it is paid. That is a bad place to go.
So with that, that covers what we were going to cover today, and it's time now for any questions people may have. Sherry, are there any questions teed up? I have some that have been sent to me that I can go to.
Oh, there's lots of questions. You've got a plethora of them in the questions area. Did you want me to read a few of them out for you?
That would be great, please.
Okay, so the first question that came in was at the very beginning of the webcast, and you said roughly how many employees did they have for the 6M ESRP? If you're not sure what that means, then
I see that one. John, you might have a better. I thought there was like maybe 3,000 or 4,000.
There's a few thousand, correct.
Okay, the next one. I have employees who choose to stay on the marketplace plan. They have, even if we offer affordable health insurance, if that employee receives at PTC, but we met the 70% requirement, will the employer be penalized?
Well, that's a good question. If the employee got a PTC on the exchange, that employee represented to the exchange that they either didn't get an offer of coverage or they got an offer of coverage, but it wasn't either met minimum value or wasn't affordable. And so if the employer, in fact, had hit that 70% threshold for 2015, and that employee who made the representations to the exchange, those were true, and it was, didn't meet affordability or didn't meet minimum value, the employer would not be on the hook for the A penalty, but could be on the hook for the B penalty. Remember, the penalties, there's A penalties and B penalties. A penalty is sort of the bigger picture. Did you offer a certain percentage threshold offer of coverage? The B penalty is with respect to each employee who got a PTC. Did that employee get that offer of coverage? Was it affordable? Did it meet minimum value? So you can satisfy the A penalty obligation, which is to offer coverage to that percentage. But if it wasn't affordable or didn't meet minimum value, you can still get taxed.
Okay, the next question actually came up quite frequently. How likely is it that my company will receive a letter to 226J?
Well, we've certainly been trying to get a sense from the IRS how long this process is going to take. They're not done with the 2015 letters. They're not going to get to the 2016 letters until they get to the 2015 letters. So if you are an employer that submitted information returns and you're over, you're at that ALE threshold, and your reporting suggested that you are exposed to an A penalty or a B penalty, in theory, it's very likely.
Just to add to that as well, one of the common perceptions was that employers would receive exchange notices notifying them that an employee was on an exchange receiving a premium tax credit, and that happened to some extent. But to a large extent, those exchange notices were not issued out. And so these letters that have been received by employers have come as a complete surprise, and that they never... Go ahead, Joanna.
Oh, and basically the IRS seems to bypass the step of the exchange certifying, and the IRS has certified it in the 226J letter.
Right. And in addition to that, the IRS is having to coordinate with multiple exchanges because some states run their own exchange, others operate on the federal exchange model and piggyback off that federal platform. So the IRS has made clear that there's still many 226J letters to be issued out over the coming weeks and months.
Now, John and Joanna, if somebody thinks that they might be at risk, are there some steps they can take now to see what their exposure might be and possibly get ahead of the curve in addressing it?
Oh, that's a great question, Gary. I mean, if even if they haven't gotten one, it is a good idea to check, and check that is obviously very important to to this review, if you haven't gotten a 226J letter, but you have some concern about your filings, is, audit it yourself. Ask yourself if the data that was used to come up with the information that's being reported, was that reliable data? And if it was reliable data, were the codes properly applied? Is there a right count? We've seen time and time again where employers have overcounted their full-time employees, and that is the big trigger on the A penalty. And so, if you don't have the expertise, get somebody who does know how to do it. But it's really important to check yourself, because if you typically have a 30-day window, you will get an extension, a reasonable one, if you request it. That's what we've certainly seen. But typically that reasonable extension is maybe another 30 days. And the longer it takes for the IRS to send out the 226J letter from the original filing, I mean, they're not even done sending out letters on 2015 filing. That means you would need to know the data for January 2015, and it's now more than 3 years later. I mean, if they're still going, I mean, if they are not even done at the end of the year, it's just all that data you need to hold on to and review. So the longer it takes, the less likely you're going to have that data at your fingertips. So it's really important to do it sooner than later.
There was another question asking who is eligible to sign the statement.
Someone authorized to sign on behalf of the company.
Okay, and what does the IRS consider affordable for employee health coverage?
There is a standard. It is, the sort of general rule is 9.5% of the employee's income. If that gets adjusted annually, so it's, I think it's currently at, like, John, do you know the numbers, at 9.56 or 9.59? It's around 9.5. That's the key. Now, because employers typically don't know what the employee's household income is, there are these safe harbors. And John had mentioned earlier about the 2 series codes. There's 3 safe harbors that employers can rely on. That is the FPL, the W-2, and the rate of pay safe harbors. These are numbers that the employer will know, and they can use that as a basis. So, for example, if the employer wants to use the FPL or the federal poverty line safe harbor, just for last year, I think it's around 90-something bucks a month. If the employee is paying below $90 a month for coverage, that's affordable, regardless of what, in fact, that employee's household income is. So an employer can rely on that safe harbor, and for purposes of the IRS and the 226J letter, the IRS will consider that offer affordable.
And there's still quite a few questions, and we won't be able to get time for all of them, but I will read this last one. Can we correct a 2016 if we know that it is not correct?
Yes, you can.
That was a quick answer. So Sherry, one of the things is that we have contact information at the end of the presentation. If anybody would like to contact us directly with their questions, they can reach out to any of those individuals. And Sherry, if you like, if there are questions that we have not been able to answer, if you would forward them to us, we'd be glad to respond to everybody in writing to help them to address their question.
Absolutely. Well, Gary, I would like to thank yourself and Joanna and John and First Capital Consulting. This webcast has been very informative, and I'm sure it really helps shed light on what could be a very potentially scary situation for some people. So thank you very much for presenting this for us today.
Well, thank you to everybody who attended. We really appreciate you taking the time, and we hope that you found it to be useful. And again, please don't hesitate to contact us if we can share any additional information.
Excellent. Now, I've just got a couple of reminders for the attendees. If you would like to view this webcast again, the archive recording and slides will be available for up to 7 days for our free members and without restrictions for those with their certification membership. All webcast credits are stored in your HR.com account. Watch for your HR.com email to arrive within 2 business days, and it will contain the certification credit information. Your feedback is very important to us, so please do take a few moments to fill out the exit survey that will appear on your screen once this webcast has ended. And this does conclude the webcast. Thanks everyone for joining us, and enjoy the rest of your day.
Thank you.